This video is going to be on how to control risk as a mortgage or note investor. And so there's a couple levers that we can pull while keeping our return the same, actually, but that significantly decrease our risk if something were to go wrong. So we're going to cover those. Everything does have risk, though, notes included, right? And so they sure do. But they, in my opinion, and in the bank's opinion, they are on the lower end of the spectrum, right? Because banks don't lend on stocks. They don't lend on speculative stuff. They lend on rentals, and they don't even own the rentals, right? And so borrowers can stop paying, properties can lose value, and foreclosures can and will happen. Now, it's not guaranteed that it'll happen to you, but as of right now, the 90-day delinquency rate, which means the amount of people that are 90 days or more late on their mortgage payments throughout the United States, is right around 1.8%. And so just remember that good investors, they don't avoid risk. Our goal is to understand it and learn how to manage it. So we have four main pillars that we underwrite from, right? And any one layer that's bad can absolutely sink the ship. So the first one we're going to look at is the borrower as a person. Okay. Is this a person that we feel comfortable lending money to? Is this a person that we feel is competent enough to use our money? Pretty simple. The second one is the property, the actual structure or the land or whatever it may be, single family house, apartment complex. Is the collateral good? Is it worth what they say it's worth? Is it in the condition they say it's in? Is the rehab budget somewhat accurate? Yada, yada, yada. The third one is the actual loan itself, right? The terms, history, paperwork. Make sure it's all structured fine. Your title company will help you do this, but just make sure the math's correct. If they tell you they're going to pay you 12% and then it ends up being stated 8%, well, somebody needs to catch that, and it's probably going to have to be you. And then our last one is price, and this kind of plays back into the property itself. But is it worth what they're saying it's worth? And should I fund that amount, right? Because overall price is going to determine your overall return. And so just keep in mind that our risk is actually going to be managed before we fund the deal, not after closing, right? Because all we do after closing is really simple, right? Cash checks. That's it. I mean, really. So all of your underwriting has to be in place. And that's the great thing about notes, is that you manage all your risk before you put a single dollar on the line. You say, hey, if this goes wrong, is my money protected? And if the answer is yes, then green light, you're good to go. So just like we were talking about, the property is your safety net, right? Because if the borrower stops paying, the collateral protects you, and more importantly, your money, right? And so we want our money to not only grow, it's very important that it grows, but it's more important that we protect our downside. And so the collateral is going to help us do that. So just as some quick check boxes, what we do when we look at the property, right? We're looking for decent collateral or good collateral. So single family home in a decent or desirable neighborhood with stable and ongoing demand. So if you go on Zillow in this neighborhood and see something has 300 days on market, right? You probably don't want to lend there. Or if there's only been one sale in the last 5 years, it's probably too rural. You don't want to lend there either. But if there's multiple listings, stuff is selling, stuff's pending, that's a good market, right? And it's in sound and livable condition. Now, as you fund more and more notes, you might get comfortable with lending on pieces of junk. But when you start out, try to lend on something that's all in one piece and doesn't need a huge rehab, because that is a great way to end up upside down, right? Because if the borrower doesn't know what the property's worth, what the rehab is, or what it's going to be worth after they're done fixing it, you probably don't either. So don't even take the chance. But if you can verify its current condition on Zillow or with a BPO from a real estate agent, you're good to go. And a BPO is just a broker price opinion. That's where the agent just drives by, goes inside, says, yep, this would sell for X, Y, and Z. So if it would sell for $100,000 in its current condition, we would feel comfortable lending $60,000 on it all day long. And so what do we generally avoid? Well, the first one, this is a big no-no, is mobile or manufactured homes. Why? Because they depreciate. We don't want to lend on depreciating assets. We want to lend on appreciating assets. So if something does happen, the asset is worth a lot more than it was when we started, right? This is your loan on the bottom right here, and this is the property. So if something goes wrong on, say this is year 5, this spread is a heck of a lot higher than it was when it started out. But if it's a depreciating asset, your spread is very thin and you don't have a big margin for error. So it's very easily avoidable. Just lend on stick-built houses, right? stuff where they dug the footer, set up the foundation, frame the house, like lend on those. Do not lend on something that they drug in from a factory and put on a foundation. Don't do it. And so the second thing we're going to stay away from are extremely distressed properties. Once again, make sure it is in sound and livable condition. Don't lend on something that has $150,000 worth of water damage. Don't lend on something that's sliding off a cliff. Don't lend on something that has fire damage, right? Unless you're familiar with those things. If you have specialty in those areas, go for it, knock yourself out. But as a first-time lender, I would want to lend on something more so, we would call them a cream puff, right? That would be my ideal target. And they're out there. You can lend on them all day long. So the next one we're going to stay away from are high crime areas. What's the test for this? There's two. Would you walk through there at night without a gun? And the second one is go on the crime maps, look up crime map, type in the zip code, and you will see a heat map, red, yellow, or green, red, and yellow. If it's in a red area, probably don't lend on it. Or you can just make sure the comps support it. And then the last thing we want to stay away from are functionally obsolete homes. So make sure the house actually makes sense. Like if it doesn't have a front door or just weird stuff like that, because people build weird things for weird reasons. We don't want to be stuck with that, because if we end up with it and have to sell it, what happens is it stays on the market way too long and it ties our money up, and we don't want that. And so just remember that better collateral means a stronger safety net if the loan goes bad. Now, once again, there's only like a 1.8% chance of that happening according to the Federal Reserve's data. But if it happens, you want to be prepared, and more importantly, be protected. So after we understand the property, we're going to understand this thing called LTV. And what does that stand for? Loan to value, right? And so what is loan to value? Well, it's a mathematical formula right here. It's very simple. It is the loan amount, so say $60,000 divided by the property value. So say we have a $60,000 loan on a $100,000 property. That is going to give us a 60% LTV. Now, if we have a $90,000 loan on a $100,000 property, that's going to give us a 90% LTV. And so typically, and you'll get this in just a second, but typically we want to stay under 75% or less, okay? And the reason for that is because if stuff goes wrong, it leaves us the 25% cushion to deal with the foreclosure, put it on the market, and still make the return we were expecting to make without any errors. Now, banks will go up to 80%. That's where the 20% down comes from. But if you go anything above that, you're really taking on too much risk, right? And if we can get the same return anyways, we would be better off going for the lower LTV. Now, 60% is pretty common. 50% is pretty common. That's where we like to stay. You can go up to 75, you can go up to 80, you can go up to 90 or 100 if you're confident with the borrower and confident with the property. I wouldn't recommend it, but you can. And I mean, it's your money. At the end of the day, you can do whatever you want with it. And so just keep in mind, 75% or less is a general rule of thumb, and you'll be pretty safe. Obviously, no disclaimer or no guarantee, nothing like that, but there you go. And so the lower the LTV, the more borrower equity. So think about that, right? Right here in this example, they have $40,000 of equity. Well, are they going to make their payment? Probably. Why? Because they want to keep their $40,000 of equity. And so that's going to leave a bigger cushion for you if stuff goes wrong, because you get control of that $40,000 of equity. So just to demonstrate it a different way, right? As your LTV rises, your cushion shrinks. And so each one of these bars is a $100,000 property. But the green is the borrower's equity cushion. So that's what they have. That's their money in it, what they want to keep. And the red is our exposure as a lender. So think about this. They have $60,000 of equity. We have $40,000 out on the property. Are they going to pay us back? Probably, right? And if not, then we turn our $40,000 into a $100,000 property. Win-win. This one, they have $40,000 of equity, and we have a $60,000 loan out on the property. So are they going to pay us back? Probably. Yeah, we could both agree that they're probably going to pay us back. And if they don't, with our $60,000, we get a $100,000 property. Win-win. Now let's go on to the 90%. 80, that's where banks stay. Banks like to stay under 80% LTV, okay? So we're not as good at this as banks. Well, you're not yet. And so we want to stay at the 60, 40, somewhere under 75. Now let's skip to the 90. Banks don't like touching this. So they have $10,000 of equity and we have a $90,000 loan. Well, if something goes wrong on this property, terribly wrong, are they going to just walk away from it, or are they going to fight till the last day to hang on to it? Well, they're probably just going to walk, right? Because they got 10 grand in it. Doesn't really matter. Move on. Now who's stuck with it? Take a guess. The lender, right? That's you. And so we don't want to do that. I would be more than happy to be stuck with this or this, but I don't want to be stuck with that. And so more equity, it just means a stronger incentive for the borrower to keep paying, because at the end of the day, all they're doing is protecting their money. And so our next pillar that we're going to look at is, can the borrower actually pay? So if it's a primary residence, that meaning if they're living in it, or if it's a vacation home or something like that, something that doesn't produce income, right? We're going to look at this thing called DTI, and that stands for debt to income. Banks look at this too. And so a healthy debt to income is 36%. First of all, well, sorry, I got a little ahead. How this is calculated is it is income. It is what percentage of your income goes to debt. Okay. So if you make $10,000 a month and your debt obligations are $3,600, you have a 36% DTI. So if we're under 36%, we're good, right? 36 to 43, you can still lend on, but it's questionable, right? Now, over 43% is a no-go. We don't even want to touch it. And so this is just for owner-occupied or second home, stuff that doesn't produce income once again. But it's just a metric that banks, and that you should look at too, when you're lending on owner-occupied property. When we're evaluating investment properties, we look at what's called a DSCR. And so that's a debt service coverage ratio. The formula for that is monthly rent. So say we have $1,000 a month divided by the monthly loan amount. And so that would be, call it $750, right? I don't actually know the math on that in my head, but I think it's like 1.33. Yeah, something like that. And so all this does is make sure that the property can support itself, because we look at the DSCR on investment properties. And so we want to make sure that the investment can support itself and the owner doesn't have to take money out of his or her pocket to pay for it. So a DSCR of 0.9 means what? The property doesn't even pay for itself, much less cash flow. We do not want to touch that. There are people out there that'll lend on a break even at 1.0. I don't understand why. It's really stupid if you ask me, and it's not a good way to protect your money. And at the end of the day, there are funds and firms out there that just have to deploy capital, right? We don't have to. We can be specific, because chances are we don't have $1 billion that we have to deploy this quarter, right? We might have $100,000 or $200,000 over the next 3 years, but not today. And so we can be very, very specific and very selective. And so a healthy DSCR, what we like to see when we lend on a property, is 1.25 or more, right? Anything above 1.5 is awesome, but 1.25 or higher is great, right? And so an example of that would be it rents for $1,250 and the expenses on it are $1,000 a month, which means the owner gets $250 a month. Now, let me ask you a question. Is the owner going to make that payment? Yes. Why? Because it's paying them $250 a month and free and clear cash flow. They're going to do that. They're going to deal with the tenants, trash, toilets, management, vacancies, turnovers. And what do we get? We get our payment. Awesome. We are just the lender. And so whether it's a DSCR loan or an owner-occupied loan, whatever kind of loan you structure, right? The payment history builds trust. And on new loans, you aren't going to be able to look at the payment history for this property, but what you will be able to look at is the borrower payment history, or if they have other properties, say, hey, have you been paying on these? And chances are, if they own other properties, then they have been paying. And so, like this loan right here, 24 months of on-time payments, that is a huge signal that we're good to go, because if they haven't missed a single payment, they haven't been late on a payment, chances are they're not just going to default and stop paying you. And so just look at your context clues, whether it be this note itself or a different property. Be aware, and if you need help with that right here, contact at thedebtinvestor.com or reach out social media. More than happy to help you. But seasoned notes are safer, and all seasoning is it's them making these payments, right? So every single month they made a payment. Now we can step in and buy month 25 to month 360, and we can do it confidently because they've made 2 years of payments. And so if a loan was originated 2019 or before, we can look at what happened in 2021 and say, did they keep making their payment? Because if they made their payment through the coronavirus, they're going to keep making their payment today. Or something very bad would have to happen for them to stop making their payment. And that's good for us, right? Because our money's protected. They're going to make the payment. And so, just another aside, the loan structure can actually reduce your risk. I have an entire another video on this. I'll put it in the description. But amortization reduces your risk, and it's just the way the loan is structured. So the payment stays the same, but the loan balance, this red line right here, actually decreases, and the owner's equity goes up over time. So the more equity they get, the more they want to what? Protect it, which means the more likely they are to pay us. And if they don't pay us, then we make more money, right? Because we have less money in the deal, and we get a property that's worth more because it's going to appreciate. And so as a lender, time is on your side, right? Risk falls with every single payment because the balance decreases, and it eventually goes to zero. And so with that being said, once again, just to recap, the 4 pillars. Our first one is a borrower. So look at the person, okay? Are they likely to make the payment? Are they trustworthy? Do we want to loan this person $50,000, $100,000, $200,000 of our hard-earned money? The second one we want to look at is the property, right? Remember, no war zones, no mobile homes. Other than that, you should be good to go, but do your own due diligence, of course. But we just want to make sure the property is solid and it's worth the loan amount plus some, right? So remember that LTV, 75% or less. So for every dollar of value at the property in its current condition, don't lend more than 75%. Next one is the actual paper itself. And this is all legal stuff most of the time. So just have an attorney review it, title companies do it, and they will make sure it's structured and it's good to go. Although it's always good to double check yourself. And then the next one is price, right? Is what you're funding this note for, or what you're buying the note for, does it leave room? Are you still making money? And are you, more importantly, comfortable, right? Do you need this money next month to send your kid to college? Because if so, you probably shouldn't buy the note. But these are the 4 pillars that we look at when we underwrite a deal. And so if these are all good, so if it's a good borrower on a good property, the documents are good, and it's at a good price, then it's a note worth funding, and we are good to go. We got the green light. And so with that being said, I hope this helps you make better decisions, make more money. But if you have any questions at all, reach out to us right here, contact@thedebtinvestor, or just go to our website. You can find our social medias, reach out to us there. More than happy to help you. But I hope you learned how to control your risk, and more importantly, why it's important to control your risk. So with that being said, I hope you learned something. I'll see you in the next one.